Now that we've gone through moving average analysis and trend analysis with the use of moving averages and guidelines, also through the range rules, it sets a trend for you if you identify direction of moving average and what range is. They should both be showing the same thing. By showing something different, your market's either chopping around or it's really unsure which way, and traders are confused because the markets do get confused. Markets don't move straight up or straight down. There are periods of consolidation. There are periods of rest. There is also a lot of time periods of utter confusion to where you have bulls and bears both expecting higher prices or lower prices fighting in a tug of war, and the data, which is your outside influence, affecting the perspective of traders. Government reports have a tendency to blow a market one way or the other to very quickly and without affecting the long-term perspective of trading. We used to have the National Association of Purchasing Managers report, which we used to refer to as the napalm bomb, because it had a way of derailing moves in bonds, stocks, currency. But if you are looking and following the trend of markets, and in this section with the pattern recognition, you can almost get an idea of which way the report should go. You already have an idea which way the market indicators are telling you it's going to go. And when I was a broker many, many years ago, I traded a lot of pork bellies. And the guys in the office, we used to take put together a pool as to what the figures would be on crop production, unemployment, whatever. And all I wanted to see was which way range was going. Did I have positives? Did I have negatives? To get an idea of which way the market should go based on whether or not it was already the numbers were already in the market or they were going to be a shock to the market. If there was a big positive that shows up in the chart and you're coming into a report and everything is lined up and the market has corrected from being a little overbought into a good, strong positive or a top-bottom support level, the report's probably going to be friendly. In reverse, if your market's rallying into a negative, you may have a report which is pretty negative and have a major effect on the market. But looking at the markets in terms of RSI, moving average, sentiment, all of it, you have an idea what should happen. The one thing the RSI gives you is what I call the edge, because you do understand trend more than most people do. And your ability to position yourself in the direction of the next move will determine not only profit bottom line, but also your peace of mind, because you're not caught with surprises. Most surprises come in the direction of the major trend. We've also heard when a market's going up, and you have to be aware of the fact that if a market goes up and very positive news comes out for that market, and all of a sudden the market fails, it was already expected. It was discounted. So how a market reacts to new input or new news can have a major impact on which way a market moves. If it accepts the news as positive and the market moves higher, okay, a lot of people probably didn't know that it was going to be that good a number. But if the market's going up and it's hit with bullish news, which should be very positive, and the market sells off, it's discounted. The market's been in a down phase and everybody's expecting something negative to come out, and the negative news comes out and the market just barely twitches and reverses, it's been discounted. But if it's a shock, it'll usually continue in the same direction. Session 3, pattern recognition, is where I want to get into the signal counts, make sure everybody's solid on signal counts. As I said before, I do have a little supplement I'm going to put with this, but I want to go through some of the basic patterns. And I had someone ask me one time if I had if there was ever a pattern that shown up that I hadn't seen before. And I told him, I said, it doesn't matter if it's pork bellies, IBM, gold, the patterns stay the same. The signal count should stay the same. Your signal count on a weekly chart is no different than your signal count on a daily chart, even down to 5-minute charts. I still use a 14-period RSI on a 5-minute, 10-minute, 15-minute, 30-minute, 60, hour, day, week, whatever you want. Nothing changes, which is what impressed me 15, 20 years ago when I first started working with it. A lot of indicators work well on a long-term basis, daily, weekly, but when you narrow them down to 15-minute and 5-minute charts, they lose all sense of alignment, all sense of timing, consistency. And I think it was even Steve Nissen who had told me one time, we were talking about candlesticks, that the strength of the signal and the degree of probability for the signal weakened in the shorter time periods. But I have seen people use it who have taken the classes. Some of you 1 minute, 3-minute charts, other people hour, day, week charts. Nothing changes. The parameters don't have to change for range rules. The parameters don't have to change for time period selection unless you want to shorten up the time frame using a 7-period or a 9-period RSI. What I mentioned also about the sentiment figures with the bullish consensus. If you shorten the time period for the RSI from 14 down to 9, it'll more closely track the actual sentiment numbers. And you'll see them pretty much range rules applying to sentiment figures versus period selection for RSI. But standard 14 has not changed for me in 20 years. Session 3, rising bottoms, declining tops. We got examples of those with a good example with the bonds in the rising bottom formation. Even though it was a double bottom in price, you had the RSI trying to rise and bottom out and make higher highs. Normally, when you're seeing that on a bottom, it's an accumulation phase. The market may have sold off for a while, and it'll last a while where it'll just bang back and forth in the lower part of the chart, but start to make higher bottoms even though prices are working lower. If you're at the top of the chart, it's more the distribution phase. That IBM chart was a good example of a distribution phase. The smart money was starting to unload as the RSI could not get back above 65, then it couldn't get back above 60. Smart money was moving out, and the not so smart money was saying, oh, my broker said, or I read, and they kept buying. The signal counts when we talk about the 2, 3, 4, 5. I've said for years, that's the same count I have used since 1978. You will see extensions. You will see hidden signals. You will see complex divergences that actually one day look like a bullish divergence, the next day looks like a negative. Then you get another bullish divergence with a lower price and it rallies into another negative. On our original checklist, bullish divergence with negatives is down. If you see a top formed and the market's still working to new highs, you'll see bearish divergence, sell into positives, new high. Sell into another positive, new high. Bearish divergence with positives is saying the trend is still up. When you get the complex divergences, it's just chaos. It's chaos in the sense of one day you get one thing, one day you're getting another. And that's really when I stress the idea of focus and discipline. What do you see? Let the market tell you what it's doing. You see a bearish divergence with positive, the trend is still up. Don't get caught in saying, well, it's going to break. This is the real divergence. It's more important to see confirmation of a trend change than try and pick one. When we talked about the signals failing, positive reversals failures, if you have bearish divergence showing with positive reversal points within that bearish divergence and saying it's still up, you have to respect it and say it's still up. If you want to get aggressive and try and sell against it and say, well, it doesn't look like the positive's going up, Well, if the positive is not going to be achieved, it should be a resistance point. If you see it hitting that resistance point or getting a little bit close to it or above it and failing to close above it, then you have an indication that it could be failing. But until you see something like that or a moving average or the activity taking place around the 60 level, respected trend is still up. If you see it on the downside and you're seeing negative reversals and bullish divergence, it's still down. If it's failing to achieve it and you think it's a negative reversal failure, you've been short probably for a while and you've made some good money. Tighten up the positions. If I could say anything about reversals in a real simple sense, it would be bottoms are probably easier to find and tops harder because people are by nature bullish and they want any reason they can find to buy. They understand the buy side. They don't understand selling something that they don't have. How can I sell it if I don't have it? Well, you sell it, you're going to give it back later. You're going to make a contract. I make a contract with somebody. I will sell you a dozen baseballs for $10. I will deliver them to you next Friday. We have made a contract. I find the baseballs for $5. I go back and fulfill my contract and deliver them at 10. I make the 5 in the middle. But people by nature are mostly bullish this is why you see the range shift. This is why you see when a market starts up, it seems to move up faster than at an accelerating rate, especially when it gets above 70. Because more and more people are convinced that it's a major breakout. You get the momentum peak, it sells off, it comes back. You can get divergence above the 70 level. Just shows it's short-term overextended. My word for it from years ago is detour. A bearish divergence is a detour. A bullish divergence is a slight detour. The market's going to go the opposite way for a little while as a detour, and then it's going to reverse again and go back the way it was going. So it just shows minor overextensions. But they are part of the checklist that we originally went through because it's the same patterns it shows over and over. We have flats to where when it's trying to form either a divergence or a reversal, positive or negative, you get the same RSI level with a positive, but the price is greater on the second bottom. But the RSI is the same price, or the price can be the same. And you get the positive reversal pattern to where the RSI drops. It drops the second time to a greater price and then turns back up. Complex patterns are ones like I mentioned before. Bearish divergence with positive reversal showing with inside the divergence. Hidden signals are signals when you look at a bar chart and you look at an RSI chart and you can note the divergence that you see if a market's making a bullish divergence. Maybe that first, your X point, remember from the signal count, is your starting point. It's your momentum low. You rally for a couple days, you come back down, you don't make a divergence on the second bottom. Even though it looks like a divergence, the price doesn't go lower. Then it rallies for a couple more periods and it sells off again and creates an even lower price than it was at the second bottom, but still greater than it was at the first. So we'll see where the RSI patterns fall. You see where the divergences fall, whether they're a simple pattern to where it's, you look at the chart, you say there's an X point, 1, 2, 3 period signal. There's an X point, up 2 days, down 2 days. There's a 4 period signal. But sometimes with the hidden signals, you'll see that X point, it'll rally for a little while, it'll come down again, trying to make a new momentum low, but doesn't go to a new price low. And then you get a couple day rally and then a retest to that with a lower price, and you actually create the divergence. It's just hidden somewhere in the chart, and you spot them. They usually come in intermediate major turns. The last one, the Cardwell Weekly. Well, I didn't include any Cardwell Weekly charts in here. That's just taking the daily RSI value off your daily chart and plotting it 1 day a week. You basically see the same thing. Range rules, positives, negatives, bull divergence, bear divergence. If it sells off into a momentum low and the following point that you plot is a lower price, but the RSI is up, it's because over those 5 days, it's been banging back and forth. And we had referred to those as a slant, either a bull slant or a bear slant. Your first pattern or diagram in this session 3 is pattern recognition and patterns and signals. Here I've listed 12 basic patterns that I've seen over the years that have been the most consistent, repeatable patterns. And any pattern that shows up has got to be a variation of one of these type. Your first one is just your simple bullish bearish. Your second one, I still use my shorthand, top bottom support, bottom top resistance, 2 to 5 day signal count, 4 and 5 positive negatives non-confirmed. That's just looking at the RSI by itself without the help of the moving averages, the 9 and 45 on price and RSI. Number 5, top bottom positive reversal. You get broken out to a new high, you sold back down to what was a previous top price level, and also showing a positive reversal at that. If I could pick a signal to buy, it would be a top bottom positive reversal with moving averages confirming it, with a clothesline support level somewhere close by. Then I put the trade on, go to the golf course, and forget about it. Because as I said before, once you make your decision to make that trade, there's nothing you're going to do. You're not going to affect the outcome of that market sitting in front of that computer all afternoon watching every tick on the bar chart. The only thing you're going to be doing is switching back and forth between your 5-minute chart, your 15-minute chart, and your bottle of Maalox that's sitting on the end of your desk. 6, the complex divergences will show examples of where you get multiple divergences. And even though price is still going down, you may get a 3 period followed by a 2 period, followed by another 2 period to where it keeps going back and forth. The hidden signals, the bull bear that'll show up, the confirmed positive negatives with the moving averages confirming, the top bottoms confirming, the rising bottoms like we showed in the bonds. The aggressive money was buying off the divergences, figuring it was not going any lower. The conservative money was waiting for that retest of the 40 on the bond chart, the 40 level on the RSI. There's nothing wrong with being aggressive. If you've just had a trade on and you got out of it and you made $5,000, you're going to be apt to be a lot more aggressive than if you had made if your last trade was a loser. Declining tops, we showed with the IBM charts. The complex divergences, like I said, multiple divergences with positives or negatives or extensions. Your next chart, the basic RSI divergences, I just put some prices in, from an old lecture, just basic concept of divergence. It was a weekly chart from way back in 92. But you see line A at the top where prices dropped to a lower level. Line A at the bottom, points 1 and 2, made a higher bottom in the RSI. A line B, higher price closed the second time around than the first, and down at the bottom chart, line B shows the RSI made a lower high. Basic divergence. The little stars marked on there, if you look at line A on the top, you made a lower point at 2 than you did at 1, which created the bullish divergence. The second line, B, showed the bearish divergence. The star shows up at where the RSI sold off to the 40 level. Range shift and bear divergence. All you need is moving average confirmation and a clothesline and buy it. Next one. We got some bulls and bears in here. If you look at line A, it was a basic bullish divergence. We had the star in there on the bottom chart at the 40 level. Then the RSI went all the way up and it broke the 60 level from before between the divergence and where the star was, the rally, the intervening rally. Went to a momentum high up along line B and a higher price high, which created the bearish divergence of line B. When you sold off down to the 30 level, look at where your clothesline support should have been, where the star was. They gave you a good long-term support level with that star at the 40. If you go to your price chart, you see where it came down, rallied, came down to where in line with that star, and it rallied up, created that bearish divergence before it sold off. But when we sold off, we did not exceed the price lows where the star was. So your long-term clothesline support is there. And it itself, when it starts playing around at the bottom, it even rallied back above 50 and then back down and created line C. Now, this is a bullish divergence at point C along this line that comes at a much higher price level than it was at point A. So what it was telling me at the time, and it's the same thing in a chart as if it had happened last week. That star came in at the 40 level. It looked like a range shift, but we never broke the price level supports from before. We come down and retested them. And then it turned back up with a bullish divergence along line C. And if you see a bullish divergence above a support line in price, then chances are it's going to be a valid bullish divergence. If it had shown up at a lower price level, I'd say it's just a bullish divergence still within the context of the downtrend. We rallied up to 60, created line D divergence on the RSI chart, but we didn't take out the highs. This is where I'm talking about markets being chaos and confusion. For a period there, that market was just in a big wide trading range, but it wasn't breaking out of the bottom and it wasn't breaking out of the top, and it seemed to just be narrowing in. You can draw trend lines on your bar charts to see wedges or channels, but using the range rules, when we come off a line C and went up and broke 60, which told us we should probably still be up, then come back and hit 40 again. Then we went up and broke 60 again and broke 70. That was a major bottom. Now, it wouldn't matter if this was an hourly chart, a weekly chart, a daily chart. If you're seeing bullish divergence followed by support at 40 or a bearish divergence followed by resistance at 60, they should be coming together and telling you the same thing. So in this case, you saw a bullish divergence along line A. Do it one more time. Along line A, bull divergence, a rally, did not break 60, but came back to 40 before it took off. And it did break 70, which said the trend range rules said it's up. Then it sold off below the 40 level, actually got down near 30, but the price level never exceeded the level that it had when it tested the 40 level the first time, where that clothesline support is. Pretty much the same thing on the very next page, where we had lines B and C on the RSI chart at the bottom. Two bearish divergences. We went down. We broke 40 at a higher level. After line B, we went down below 40. We come back up and created a bearish divergence along line C. Sold off and then could not get back above 60 where the star is. But we sold off to 40. Again, went through 40, and that was the basis of line D, which if you put a clothesline from the low made in price between the high at B and the high at C, right around that 90 level, we hadn't broken it yet, but we had a bounce in the RSI off of line D and eventually went lower and would have taken that out. So if you looked at the high made at B, the high made at C on your price bars at the top, and looked at that low in the middle there at 90, and drew your clothesline support, it wasn't broken the first time, and you had a rally. But if you look at where, after that rally, use the low on the first point of line D in the price where it peaked in price after the basis of line D, it rallied up and came down. If you use your clothesline support from the low between the high at B and the high at C, it didn't break it the first time, but when it broke it the second time, it kept going. Now again, that's a weekly chart. But the range shifted, price went to new low, RSI went to new low, and then we had to form it all again at line E. At the bottom, and the RSI, line E was the basis of the secondary price low that was hit along line E on your bar chart. It had a rally back above 60. If you can approximate where your high was with the star, where your clothesline resistance should be just above 100. Or right around the 100 level. The rally from the line of the price action along line E up to F when it had the rally all the way above 60 did not really take out the clothesline resistance that was set with the star. But people basically get caught up calling bullish divergence buy signals or bearish divergence sell signals. I've always focused on just saying it's a short-term overextension, it's a detour. It's a little overextended one direction or the other. Your next chart where it has X day and the signal count. Most people that have taken the RSI courses, most of you understand X points. It's a new momentum high upon which to start your signal. A new momentum low upon which to start your count at the bottom. The X1, when they say X marks the spot, that's all. The first thing that should come to your mind when you see a market close. Is it a new momentum low? Is it possibly an X point? Could it be a positive reversal coming off of there? Is it a positive off the last low? Is it a negative? That's a simple 1-2 bear at the top, 1-2 bull at the bottom. Your next page, signal count, is looking at the price bars in section A on that chart, the 5 period or over 5 periods. B on the left-hand side shows what the price looked like in terms of the RSI line. B is actually on the left-hand side, the RSI line drawn and labeled with the prices. So in this case, 100 is your X point, followed 104 up, down to 99, which would be X12. Down at the bottom, it's got your signal count, just marked X12 in the box C. D, E, and F relate to a bear divergence. You have your X point at 100, down to 97, up to 103, and then down. The bottom chart line or box F is X12. Everything would be wonderful if that was the way it worked. If you could just look for X12s. Your next page, I put pretty much the same thing, but put them in a box. Some people have written them in their notebooks that way. The bull divergence, bear divergence, the line on close, as far as close price, closing higher versus the RSI price. Turn your next page. Should see 3 period signals. X points, a rally day, maybe a flat day, and then it turns into a lower close at 0.3 on your top chart for your bull divergence. And on the bottom, X day, down day, day 2 is pretty much unchanged from the day before, and then a rally day which exceeds 3. Many times you will also see, in this real simple pattern, the X point, a rally on day 1 after the X. Day 2 is flat. Day 3 does not exceed the low that was made at the X point. Still working. It's still trying to evolve and figure out what it's going to do because you don't have a bullish divergence. You may rally. What's your next chart? The next chart, another 3 period, says 2, 3, flat, simple 3. where 2 and 3 are flat now, about unchanged. Can or cannot be in divergence, depending what the price action is showing at the points. Your next one I called a curl simple 3, where you make the X point at the top chart, you rally, and then it's just kind of rolling over, curling over. If it's a divergence, you watch it. If it's not a divergence, say it might rally again to another high and then drop to another low. After point 3 at the top, rally up to 4, down to 5, and maybe 5 and 3 become your bullish divergence, where 5 would be less than 3. That would be more like a hidden signal, because your X point here is your momentum low, followed by 3 periods later, no bullish divergence, followed 2 periods later by a bullish divergence. We've got an example in there too written out. Your next one is the flat signals, where you start off with your X point, you rally a couple periods. That 3 that's marked at the top should be closer to the dot on the left, not out there on its own, so that you hit that peak at 2 and then drop to 3, then drop to 4, where the RSI could even be the same price. Excuse me, not the same price. The RSI value at 4 could be exactly the same as the RSI value at 3, or at the X point. You'd have equal RSIs and possibly a lower price close. It's called a flat. And a lot of people ask me, well, that's not a divergence. Well, it's basically a divergence. It's what I call a flat divergence. The inverse down at the bottom, where at X you make a high, the RSI goes up, sells off 1-2 periods, rallies back on periods 3 and 4, and the price at point 4 may not be greater than the price was at X. The RSI may not be greater. Could be exactly the same in both price and RSI, where the RSI value at 4 equals what it was at 1. The price could be the same or it could be greater. It's just a flat and reverse. The next one, 1-3 right. I tried to come up with names for things so I can reference them. Where the X point stands top chart, the X point stands all by itself. You get a big rally up and then 3-day sell-off afterwards. Market shoots up, and all of a sudden everybody said, that's a breakout. And then it sells off for 2 or 3 days. And everybody said, oh, it wasn't a breakout. So they're not in a hurry to buy it now, because now it's selling off again. The inverse at the bottom. You had an X point, you had a hard down day, and then next 2, 3, day 2, day 3, and day 4, or period 2, 3, and 4, it rallies up, creates a bear divergence. The next one is marked 4 period, 3, 1 left, top chart, 3 days up, 1 hard day down. Inverse down at the bottom, 3 hard days, 3 down days, and then 1 quick rally. A lot of times you'll see this pattern when the market has been trying to bottom and people are talking about it bottoming. So you're getting people starting to nibble, and it runs a couple days on the top chart. It starts to run up for a couple days, and then maybe some major influence comes out, a brokerage firm or something downgrades the stock or downgrades the general market, and then you get a hard down day. And the average guy on the street says, well, it's probably over. You know, it's still going down and whatever. But if your time cycles are coming and you see something like this, where the X day is down around the 40 level or even the 35 level like that bond was, and you get a 2-day signal followed by a pullback into a 3rd day, you might be all right. You might be looking at something that's pretty big. The next one, 2x2s, 2 days up, 2 days down. The next one, 3 flat, simple 4, I called 2-3 flat, where points 2 and 3 are pretty much unchanged, a little bullish divergence. The bottom chart, you get the hard down, 2 days in a row, it goes flat and comes back up. When markets don't change from up to down. Markets change over time, and when all the different time cycles or time frames, the hourly chart, the daily chart, and they're all coming together at about the same time and telling you there should be some sort of bottom, it seems like it reverses on a dime, but it's a building phase. Now, positive reversals, when they sell off into a positive, you're going to get a quick turnaround. If it's a good positive, your moving averages is there, your support's there, you've drawn your clothesline support, and it sells off into that area you expected to see, it snaps out of it and goes up. The negative, same thing on the downside. Your next one where I have X and X2 is more one of those hidden signals you'll see. Or a double divergence, I like to call it. You get a divergence with X, a rally up to 1, sell off to 2. And then a rally, and then another sell off. And the reason I said X2 is X2 could be lower than both X and 0.2. You made another new low, but you never went down lower. You remember the bond chart? Made a low, made one type of divergence, then came into like a little 2 period. Then there was another higher divergence hanging further out at exactly the same price. Then you get a new high and turn up. Your next one, you have an X, a rally up to 1, sell off to 2, another sell off to 3. Now 3 is probably going to be below X, what X was. But now you get a little rally, could have rallied into another negative and turned down at X2, and then a rally up 1, down 2. You got 2 signals back to back. The price at X2 could be lower than X or 3, where it was at 3, or it could be the same as X. In that case, you could almost count it 1 from X, up 1, down 2, down 3, up 4, down 5. There's different ways you can count them, but I'm trying to get to a standard of what I've seen over the years. The next one's just a different variation where you have X, rally up to 1, sell off to 2 at X2, and a rally to 3, where 3 might have been higher than it was at point 1. So you're starting from this point X2 with a new low, a new high at 3, and a sell off to 4, which could be below where it was at 2 before it turns up again. Your next one is a bearish divergence pattern with the momentum high at X, a sell off to 1, up to 2, down to 3. Then after point 3, it sells off another time. Now, if it's lower after that sell off from point 3 than it was at point 1, you'd have a positive. If it was lower, you'd say, well, it made a lower low. And then all of a sudden, from that lower low, it goes all the way up to X2 at a price that both exceeds where it was at X, where it was at 3, and puts in a little 2-period bear. This type complex pattern comes from when you see a bear divergence with positives in it. And you have to respect it still as a uptrend because you're still bear with positive. Your next one, I extended the count a little further, 1, 2, 3, 4. And then the market basically goofed around for a few days, sold off, and went back up and started a whole new divergent count, bearish divergence count. This type of pattern you see more often when it's in an intermediate trend change. This is the one that I've seen to where it looks like the divergence is clean, it starts down and stops, and then comes back up. You remember we were talking about drawing clothesline support? This particular pattern, when it goes from X, 1, 2, and maybe on day 3, it jumps up. And you can draw that clothesline support line at point 2. You thought it was, all right, here's the start of something, and it goes up to a new high. But when it comes down after point 4 and tries to go down, it doesn't break that clothesline support that we drew the line on close because it doesn't break it. And when it doesn't break it and market comes back up, you may go to a new high at X2 and sell off again. And on the next sell off at point 2 from your X2 high, you don't break it again. And it goes up again to another high. It's like hanging on and barely getting to new highs. Your next one, X down to 1, up to X2, down. This is like a your first X is your momentum high, then you get 2 successive new price highs at 2 and 4. Because at 2, it's higher than it was at X in price, and at 4, it could be higher than it was at X and X2. You sell off one more time, and then you get like a 50% rally of what it fell, and it can't get back to the line you've drawn on your divergence. Your next chart, we get into the signal counts and everything here with the positives and negatives. But the reason I wanted to go through more of the bearish counts, and they're just inverse. You can flip them upside down. If you have it, just take the paper or your chart. I used to do this, and I'll tell you, I actually have burn holes in some of the charts I do by hand, flipping it upside down or whatever, because I put it too close to a light bulb. But the patterns are inverse. A bear divergence, when you flip that chart upside down, becomes a bull divergence. A positive reversal, when you flip it upside down, it becomes a negative reversal. But the patterns that we're looking at, the reason I show the bear patterns first is tops are more difficult to identify because people do not want to give up that bullish, that idea that we are still bullish and we're going to stay bullish. You know, I missed it the last time it was this low. I'm not going to miss it this time. So a market hangs on and hangs on. The bearish divergences also, as we said, are detours. If you see a pattern that gets real complicated and it's hanging with negatives, with bear divergence showing and positives in the middle, then it's a market that's trying to top out but is not ready to do so yet. Your biggest trend change signal is still your negative or a range shift or the moving averages turning down or all three in concert. But the bear divergences I try and spend more time on only because of the fact that they're where a lot of people say, oh, it's a bear divergence, it's time to sell and get short. If they do and the market goes through it, they're very apt to get right back in it. Where with a bullish divergence, if the divergence doesn't hold, even if it holds for a couple days, people say, well, that could be a bottom. But once it goes to new low, because price goes to new low, they understand they no longer want to be holding it. And it'll accelerate down through the bearish divergence. Session 4, more on signal counts, reversals, and patterns. I'm putting these two sessions together and trying to cover them together because of the fact that the patterns, when you look at charts, you'll see the divergence, bullish divergence, bearish divergence. Then maybe a positive, then another positive to confirm. Or in the case of the bullish or the bearish divergence, the bearish followed by the negatives. But in your order in which you should be looking for them, bearish divergence followed by negative confirms the bear D or the bearish divergence. Once it's followed by a negative, the bullish divergence needs a positive to show up soon after to confirm that that bullish divergence is real. And also find support if we're coming from below 30 or around 30, break the range and come back and find the range. So where some of this, most of this is review, I'm trying to stress certain points over things that I went through in the other courses because of the fact of these clothesline supports that we've talked about are a good indication of whether these bullish and bearish divergences are going to last. If you see a bullish divergence forming at the bottom and the next day the market opens up and goes up, and you can draw your clothesline support on what your lowest close is, that should give you an indication that the market is indeed trying to bottom. If you see a bearish divergence with that high close, the following day, usually with a bear divergence, you're going to open up, trade up, and sell off during the day. So you may have to wait and see that clothesline form the second day. But if it's a real strong signal, that clothesline resistance points and clothesline support lines help you to identify what price structure looks like in relation to the divergence patterns. The signal counts tell you what you should be looking for in terms of momentum. Combining the two gives you an idea where price and momentum are actually trying to turn at the same time. The next chart here with the simple positives and negatives, we took that out of the basic class. That's the standard one. We won't go through that. The next one, a positive reversal. One is drawn on the line on close. One has what the signal count looks like in the RSI. We have the negative reversal lines the next day. And these are all simple, just 2 periods, just to get you folks always clicking. The next one has all 4 on one chart. Chart 5, well, I call it chart 5. It's actually from the basic level, where when you look at an RSI chart, that's what you should see. You should see bearish divergence, upper left-hand corner, followed by negatives. Lower left-hand corner, a bullish divergence, followed by positives. Within the course, in the edge here, I also put in a little section on at what levels you should see what type of patterns. But this one chart here, with the upper left being bear, followed by negatives, lower left being bullish, followed by positives, that's the way the world works in RSI. If you see a positive reversal after a bullish divergence, that should be your bottom. If you see a bearish divergence followed by a negative reversal, that negative is confirming that bearish divergence is real. Your next chart is the one I called the complex bear divergence with positives in the top half, and the complex bull divergence with the negatives. Top chart has your X point marked at 0.5 or 25. And I use numbers so that you can see price and number together, or price and RSI value together. You have X with a value of 25, not the RSI value. Just think of it as stock or whatever market. Sells off to 24, down to 23. 21 and 23 are positives, saying that the market should go to 27. If that market's going to go to 27, 21 should be your clothesline support. So it doesn't violate it at 23. The reason I like those clotheslines is it gives me an indication where support is and where I'm wrong. So I watch it at 21. It comes from 23 up to 25, goes to 26. Now you've got a divergence of from exit 25 down to 24, 1, down to 23, 2, up to 25, up to 26, 4 period. But you've got a positive reversal in there. Then it sells off from the bear divergence, and normally on 0.26, the market will open higher, look like it's going up, and then go down. Drops to 25, drops to 24. Now you've got 2 positives in a row and a bear divergence. The market tries to rally back up. We're still looking for a target based on the positives with the close at 21 prior to the X period and the close at 23. We have a 1, 2, 3 period signal, positive reversal, that says we should go 2 points above the X high, which was 25. Until we break 21, you don't have confirmation that it's going down. At least not over a couple weeks or a couple periods here. And you're still looking for a target of 27. When you go from X down 1 up down 2 to 23, up to 25, 26. You got a 4-period bear divergence that sold off again 2 periods later into a positive with the 24 versus the 23. 1 point positive added to 26 now. Says 27. So you got the same pattern with a positive or same price objective. But it only comes to 26 and is meeting resistance at that line that you're drawn on your RSI chart. And it sells off from that dotted line from 26 down to 25. Now we still haven't achieved that target. And we still see resistance at 26, but we've on that on the clothesline resistance, which you should have drawn first at 25, and then 26 broke it. It went to a higher close. Well, where's the clothesline resistance? Was it maybe at 27 or 28? Is the market not breaking above it, or is it staying below it? When we sold off last time before we broke through that line, we had that last positive of another point, of 1 point of 24 versus 25. We did rally to 27 and almost created another divergence, like a double hidden signal or 2 bear divergences in a row. But the positive has to be respected and say that it's still up. Bear divergence and positive. When you see this type pattern and it looks like it's topping and it's still kicking positives, this is where it almost takes the patience of a saint. But if you know where your clothesline support and resistance are, you have an idea of what should hold as support. I'm still viewing this chart as on its way to 27 because I'm seeing bear divergences with positives. And 21 is your first clothesline support. So if I know on that last sell-off to the 25, to the point 25, it hasn't broken 21, it's getting further above 21, chances are it is going to break out to the upside. You achieved the 27 target with this 2-point move from the low at 25 up to 27. You're getting near that bearish divergence line again. This is where the patience thing comes in. If you had bought even at 23 with a stop under 21, or bought at 24 with a stop under 21, when it broke through that downtrend bearish divergence line, you're negating the divergence line. You're also going beyond the positive reversal target at 27. Now you're closing at a new high at 29. So you can see where bearish divergence with built-in positives can create a lot of confusion because you start looking at it and saying, it's a bearish divergence, but it has positives. Well, which way is it going? A lot of people have seen these patterns and said, why does it do that? I said, it just does. It's chopping back and forth and seems to be trying to top out, but also the underlying trend is still up. Not what I'd call a simple little pattern. But this chart here and the one below it, which is the inverse, where it's trying to make a bullish divergence, the bottom chart, the bull divergence with negative reversals built in. These charts confuse a lot of people because you see two things happening at the same time, but you're an RSI course student and you're well aware of the fact that with your trend analysis checklist, bearish divergence and positives come in uptrends, bullish divergence and negatives come in the downtrends. Patterns like this are very dynamic and very powerful because when they do break in the direction of what it should break, that top chart, when it breaks out, chances are it's going to blow out not only the price objective, and when we set that positive reversal target at 27, it's closed above it, it achieves it, and then it goes beyond it. So the clothesline support then might have come all the way over to your last low on that top chart at 0.25 in the lower right-hand corner before the explosion to the upside. But these patterns, and I still, to this day, do my charts by hand because I want to see patterns like this. I want to see the confusion and the chaos because I'm looking at probability, and probability is saying if I'm seeing bearish divergence with positive reversals built in, When this baby blows the top off, it's going to fly. This is not only, I would say, it happens at intermediate turns. I'd say it happens probably more often at major turns, unless you've got a simple 2-period reversal, bullish divergence, or in the top chart. If that first, in the top chart from X, 25 to 24, down to 23, back up to 26, from that initial sell divergence or bearish divergence, where we had a positive targeting 28, actually 2 points above the highest close at 26. If it had sold off and broke the clothesline support that you had drawn at 21, chances are that's a solid bear divergence signal. And I always say bearish divergence is bullish. It's only a detour or an overextension. But when you see a signal to where it goes into a complex pattern like this and turns and continues to show positives, but it's not going down, but it's not really going up, you have to respect it as a pattern that is an up pattern until you have either broken below the previous support, or if you have access to hourly data, you spot an hourly on a negative reversal on an hourly or a range shift on an hourly. How do you do that? If you don't have online, watch the prices during the day or call a broker or have somebody watch it for you. Call me if I'm there. I'll tell you. But watch to see if the highs today are higher than yesterday's close. If the high today is higher than yesterday's close, could be breaking that clothesline resistance. If today's low is below, if after point X first time down to 23, if 23 turned out to be a clothesline support level, yet today's price action is below 23, chances are we're going to fail to go above 27, 28. But if today's low is still greater than the close was a couple days ago with that clothesline support at 23, it's going to stay up. This type of pattern we saw recently in crude oil too. With the clothesline support, it was coming back, but it wasn't even creating positives. If a market sells off intraday and comes down what should be, if it closed there, a positive, means it's going up, but it gets down in that level and turns up first, then it's even stronger than you realize it is. We also went through points with pivot point projections, pivot highs, pivot lows, which we'll get to a little bit later. And the pivot highs being based on price analysis alone give you price objectives for the following period's trading. So it's another way you can identify a support. If the pivot high for, say, after it had sold off after 2 divergences in a row, sold off to that price low at 25, came up to 27, and the next day your pivot low was 24 and a half. You know where support is. If your pivot high was 28, you know where resistance is. And you're talking to your broker or talking to a friend, say, hey, check and see what this is for me. But you're going to do your pivot price projections based on today's price activity for an idea what the range tomorrow should be. But of all the patterns that I've shown in all the courses I've taught, this one at the top is the one that screws most people up, confuses most people, and is one of the most powerful patterns to where you get the divergences, bearish divergences with positives at the bottom of it. The inverse at the bottom. In the last 6 months, the yen has been slammed pretty hard with the dollar going up. But this bottom chart, complex bull divergence, there were times when we had what looked like a bottom in the yen, and it would rally. It'd be a negative, go down into a bull divergence, rally, be another negative, and then break out to the downside because you had bullish divergence and negative saying the trend is still down. And some of the rallies in the RSI and even in CFG would get up to their moving average and be a negative, and it got hit hard. Sometimes you'll see this pattern around the 40 level before it changes the 80-20 to a 60-20, from 80-40 to a 60-20. First time down at 40, you'll see a pattern like this. It may run up for a week, but it doesn't take out the previous bottom which was support before, which is now becoming resistance, and that clothesline resistance is coming across there.